Let me ask you something simple. Imagine you walk into a store and the item you've been watching for months, something you know is high quality, something that holds its value, is suddenly marked down 40%. Not because it's broken, not because it became less useful, just because the store is in a panic and slashing prices to move inventory. What would you do? Most rational people would say that's a buying opportunity. Now imagine the same logic applied to the financial markets, to ownership stakes in real businesses that make products people use every day. Businesses with revenues, employees, customers, and decades of operating history. When those go on sale, not because the business broke, but because emotion took over the market, most people do the opposite of what they do in that store. They run away. That gap between what people do and what the data suggests they could do is what this video is about. My name is AR, and on this channel we break down how money actually works in plain language. Today I want to walk you through one of the most important and most misunderstood patterns in the history of financial markets. Not to tell you what to do with your money. I'm not a financial advisor, and nothing in this video is financial advice. But by the end of this, you'll have a mental framework that most people spend decades trying to build, and some never do at all. Stay with me, because this is the kind of understanding that genuinely changes how you see the financial world. Let's start with a question that sounds almost too simple. Why do markets crash? Not the technical answer, the human answer. Markets are, at their core, a reflection of collective human behavior. Millions of people making decisions based on information, expectations, emotions, and instinct. And human beings, as brilliant as we are, have two emotional settings when it comes to money that tend to override rational thinking. The first is optimism, sometimes excessive optimism. When times are good, when portfolios are growing, when the news is positive, people start to believe the growth will never stop. They start paying higher and higher prices for assets, not because the underlying value justifies it, but because the momentum feels unstoppable. Economists call this irrational exuberance. The rest of us might just call it excitement. The second setting is fear. And fear, when it takes hold of a market, moves faster than almost any other force in finance. When bad news hits, a recession, a global health crisis, a banking failure, a geopolitical shock, the same people who were optimistic yesterday start selling. Sometimes they're selling to protect themselves. Sometimes they're selling because everyone else is selling, and that feels like the right thing to do. Here's the critical insight. Neither of these emotional states is tied directly to the actual value of the underlying businesses. Think about that for a moment. A company that sells software, or makes medical devices, or runs a logistics network doesn't become twice as valuable because investors are excited. And it doesn't become half as valuable because investors are scared. The business is still operating, the customers are still there, the revenue is still coming in. But the price at which that company trades can swing wildly based purely on emotion. This is the pattern. It has repeated itself throughout modern financial history. It's not a secret. It's not a conspiracy. It's just a predictable result of human psychology operating inside a system where prices are set by collective behavior. And understanding it, really understanding it, not just intellectually but emotionally, is the foundation of long-term financial thinking. Now, I want to be careful here. History is not a guarantee of future results. Anyone who tells you otherwise is either mistaken or not being straight with you. But history is the best evidence we have. And the evidence, when you look at it honestly, tells a consistent story. Let's go through it. This is the one everyone knows. The stock market collapsed in 1929, and what followed was the most severe economic contraction in modern American history. Unemployment reached staggering levels. Banks failed. The suffering was real and widespread. But here's what most people don't know. An investor who began putting money into a diversified portfolio of American stocks in the early 1930s, at the depths of despair and held patiently, saw extraordinary long-term returns over the following decades. The recovery was slow and painful, but it came. In less than 2 years during the early 1970s, the US stock market lost nearly half its value. The causes were complex: an oil embargo, inflation, political instability. The mood was bleak. Many serious analysts at the time questioned whether the economic model could survive. It survived. The market recovered. The businesses that had real operations continued operating. And investors who held or added to positions during those dark years were significantly rewarded in the decade that followed. On a single day in October 1987, the Dow Jones Industrial Average fell by over 22%. In one day, if you had turned on the television that morning with a portfolio and watched the numbers, it would have felt like the end of something. But within roughly 2 years, the market had returned to its pre-crash levels. Within 5 years, it had grown well beyond them. The people who froze in terror and sold knew the bottom locked in permanent losses. The people who did nothing, or who added money, were eventually rewarded. This one is particularly instructive because it involved real overvaluation. The technology sector had been priced at levels that couldn't be justified by actual earnings or business fundamentals. When the correction came, it was severe. The Nasdaq fell roughly 78% from its peak. But notice what happened next. The internet didn't disappear. The technology didn't stop being useful. The underlying businesses that had real models, real products, real customers, survived and eventually flourished. The correction wiped out the speculation. What it left behind was the genuine value. Triggered by systemic failures in the housing and banking sectors, the crisis caused major indexes to fall dramatically from their peaks. The news was genuinely terrifying. Major financial institutions failed. Unemployment spiked. Entire industries contracted overnight, but the market bottomed. And from that point forward, the following decade became one of the strongest periods of market growth in history. An investor who put money into a diversified index fund near that bottom saw returns that transformed long-term financial pictures. The fastest major market decline ever recorded. In roughly 23 trading days, broad markets fell 34%. The world was shutting down. The future felt genuinely uncertain. The recovery was equally dramatic. Within months, markets had not only recovered but reached new highs. The businesses underlying those markets, technology, healthcare, consumer goods, logistics, had adapted, evolved, or in some cases accelerated their growth. Now, what is the common thread across all of these? Not that crashes are painless. They're not. Not that recovery is guaranteed on any specific timeline. It isn't. The common thread is this. In every instance throughout modern financial history, the businesses underlying broad market indexes continue to operate, adapt, and generate value over time. And investors who understood this, who separated the price of something from the value of something, were positioned to benefit from the eventual realignment of those two things. Understanding history is the easy part, honestly. You can read the numbers in a book, you can study the charts, you can nod along to everything I just said. The hard part is what happens inside your head when you're actually living through one of these events. Let me try to describe it. It's not just that prices are falling. It's that everything around you confirms that they should be falling. The news is alarming. Respected economists are issuing dire forecasts. Your friends are talking about pulling their money out. Your family is worried. Your gut is telling you that something is fundamentally different this time. And here's the thing. Sometimes there is something different. Each crisis has its own specific cause, its own unique characteristics. It would be intellectually dishonest to pretend otherwise. But what the historical record consistently shows is that even when things are genuinely different, even when the cause of the crisis is novel, the underlying mechanism, businesses operating, humans consuming, economies adapting, tends to reassert itself over time. Problem is that our brains are not wired for long-time horizons when we're in acute stress. There's a well-documented phenomenon in behavioral finance called loss aversion. Research suggests that the emotional pain of losing a given amount of money is roughly twice as powerful as the pleasure of gaining the same amount. This means a financial loss feels approximately twice as bad as an equivalent gain feels good. This is not a weakness. Evolutionarily, it made sense to be more sensitive to losses than gains. That instinct protected our ancestors. But in the context of long-term investing, it becomes a significant obstacle because it causes people to sell during downturns, locking in losses that might have been temporary, and to hesitate during recoveries, missing the early stages of growth that tend to be the most powerful. There's also recency bias, our tendency to assume that whatever just happened will continue to happen. After a period of strong growth, we assume growth will continue. After a sharp decline, we assume decline will continue. Neither assumption is reliably accurate, but both feel extremely compelling when you're inside the moment. And then there's social proof, the deeply human tendency to use other people's behavior as a guide for our own. When everyone around you is selling and retreating to cash, the implicit message is, that's the safe, smart thing to do. Going against that current requires not just financial knowledge, but genuine psychological fortitude. This is why financial literacy alone isn't enough. Understanding what to do is only half the challenge. The other half is building the emotional architecture to actually do it. So let's talk about how to actually think about this. Not as a strategy to get rich, but as a framework for understanding what investing in broad markets actually means. The price of a stock or a fund at any given moment is a data point. It reflects the collective mood of the market right now, the sum of optimism, fear, speculation, and circumstance of this particular moment in time. The value of the underlying business is different. It reflects the actual earning power of that business, its competitive position, its assets, its future prospects. Value changes too, but it changes much more slowly and for more fundamental reasons. When markets crash, what typically changes dramatically is price. Value often changes much less. The gap that opens between price and value during a crash is precisely what patient, long-term investors are paying attention to. Here's something that doesn't get discussed enough. The stock market, as measured by broad indexes, has historically never delivered a negative return over any 20-year rolling period in its recorded history. Let me say that again because it's important. Over any 20-year period in the recorded history of major broad indexes, an investor holding a diversified position has ended up ahead. Not every year was positive. Some stretches were brutal, but the direction, over 2 decades, has always been upward. Now, past performance is genuinely not a guarantee. I want to be clear about that, but it's the strongest evidence we have. and it suggests that the primary variable in long-term investing isn't picking the right stock or timing the market perfectly, it's time itself. The longer your holding period, the more you're letting the fundamental growth of the underlying economy work for you, rather than fighting against short-term volatility. Individual companies can and do fail. Industries get disrupted. Technologies become obsolete. Any one company, no matter how dominant it seems today, carries real risk. But a broad index fund, something that holds hundreds or thousands of companies across many sectors, behaves differently because it doesn't need any one company to succeed. It needs the overall economy to continue functioning and growing over time. And historically, economies do grow, not in a straight line, not without painful interruptions. But the long-term trend of human economic activity has been expansion, more productivity, more innovation, more value creation. When you invest in a broad index, you're essentially making a single bet that human economic activity will continue over the next few decades. That's a very different bet than picking a winner in a single company or sector. There's a strategy worth understanding called dollar cost averaging. The concept is simple. Instead of trying to invest a lump sum at exactly the right moment, which is essentially impossible to do reliably, you invest a fixed amount at regular intervals regardless of what the market is doing. When prices are high, your fixed amount buys fewer units. When prices are low, your fixed amount buys more units. Over time, this naturally results in your average cost being lower than the average price over the same period. It also removes the psychological burden of trying to time the market perfectly. You're not trying to call the bottom. You're just consistently participating in the market over time at whatever prices it offers. This approach won't produce the dramatic single-moment gains of someone who perfectly called an exact market bottom. But it also removes the risk of making a large lump sum investment at exactly the wrong moment. For most people, especially those building wealth gradually over a career, the consistency and psychological manageability of this approach has significant practical advantages. Now, within a long-term investing framework, are there periods that are more significant than others? Yes, and I think it's worth being honest about this. When markets undergo corrections of 30%, 40% or more from recent peaks, when broad indexes fall significantly, not just a routine small pullback, the potential return available to new money entering the market increases substantially. This is straightforward math, not prediction. If you can buy the same asset at a 40% discount compared to its recent price, you need it to return to its previous level to make a significant gain on your investment. The further prices fall below recent valuations, the greater the mathematical potential to full recovery. This is not the same as saying markets always recover immediately, or that buying during a crash guarantees profit. Neither of those statements is true or responsible. What it does mean is that the risk-reward profile of long-term, diversified investing tends to be more favorable when valuations are compressed by fear than when they're elevated by optimism. You can look at various signals to gauge the general climate. Are broad market indexes significantly below recent highs? Are measures of investor sentiment indicating extreme pessimism? Are valuation measures for broad indexes at historically low levels relative to their own history? None of these signals tell you when to buy with precision, but together they can tell you something about the general environment, whether you're buying in a climate of fear or a climate of exuberance. And broadly speaking, the historical record suggests that long-term investors who entered the market during periods of fear tended to see better long-term outcomes than those who entered during periods of maximum optimism. That's not advice. That's just what the data shows. Let me bring this down to practical, grounded thinking. If you're at the beginning of your investing journey, or you're someone who has savings set aside for long-term goals, not emergency funds, not money you'll need in the next few years, but genuinely long-term capital, here are some frameworks worth understanding. Understand your time horizon first. Money you might need within 2 to 3 years shouldn't be exposed to significant market volatility. Markets can stay depressed for extended periods, and you need to be able to ride that out without being forced to sell at the wrong time. Long-term investing only works if you actually have a long time horizon. Keep it simple and diversified. Broad market index funds, instruments that track hundreds or thousands of companies, have a decades-long track record of outperforming the majority of actively managed funds over long periods. This isn't because the managers of those active funds are incompetent. It's because fees compound against them over time, and because consistently predicting which individual companies will outperform is genuinely very difficult, even for professionals with enormous resources. Build the habit of consistency. Regular contributions to long-term investment accounts, the same amount, at regular intervals regardless of market conditions, tends to produce better outcomes for most people than sporadic, emotion-driven investment decisions. It also builds a relationship with the investing process that makes it feel less daunting over time. Pay attention to your own psychology. This might be the most underrated factor. Know your own risk tolerance, honestly. If a significant market decline would cause you to panic and sell everything, then you probably shouldn't be heavily invested in volatile assets regardless of what the theoretical long-term returns suggest. The best investment strategy is the one you can actually stick to through difficult periods. And importantly, keep learning. The financial world is complex. There are aspects of personal finance, tax strategy, risk management, and investment vehicles that genuinely require deeper study. Nothing in this video, or any single video, is a complete education. Think of this as a starting point, a framework to hang more knowledge onto as you continue learning. Let me leave you with this. One of the quieter truths in the history of investing is that the people who built the most durable, long-term wealth were rarely the ones who made the most dramatic calls or took the most exciting risks. They were, more often, people who understood one simple thing deeply, that the financial world moves in cycles, that those cycles are driven by human emotion, and that emotion, while powerful, is not a reliable measure of underlying value. They understood that fear, while it feels like information, is often just noise that temporarily disconnects price from value, and that when that disconnection becomes large enough, time and patience have historically been rewarded. This isn't exciting, it doesn't make for dramatic headlines or compelling short-term stories. It doesn't give you something to brag about at a dinner party the way a hot stock tip might. But it is, as far as the historical evidence suggests, one of the most consistently reliable frameworks for thinking about long-term wealth building that exists. You don't need special information. You don't need to predict the future. You don't need to understand complex financial instruments or study quarterly earnings reports. What you need is a clear understanding of how markets work over long periods, the emotional discipline to act on that understanding even when it's uncomfortable, and the patience to let time do its work. The cycle will repeat. Fear will return to the market at some point, as it always has. Whether that moment becomes an opportunity or just another anxiety-inducing news cycle depends almost entirely on the framework you built before it arrives. Build a framework now, while it's quiet. Think clearly now, while there's no panic to cloud your judgment, so that when the moment comes, and it will come, you've already decided who you are as a long-term thinker. That's the real preparation. And that's what this channel is here to help you build. I'm AR. If this way of thinking about markets resonates with you, subscribe to AR Investor. We cover these concepts regularly in plain language for people who are serious about understanding how money actually works. Take your time with what you've heard today. Think it through. And as always, do your own research, consult qualified professionals for your specific situation, and remember that this video is educational content, not financial advice. See you in the next one.